That's kind of how I see this playing out. If we assume we have parallels to the dot-com boom and the great financial crisis right now, that's how I see that playing out. 12 to 18 months, boom, 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 like crazy. And then the next year or two, big washout, great buying opportunity, and the next 10 to 20 years, steady secular growth in AI.
Hello and welcome to Being Exponential with Lango, where we'll be discussing the markets, the economy, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is September 23rd. Let's dive right in. All right, Luke, we are currently in the office today. We're working on a little project. You might see it in the next couple of weeks or so. However, I want to dig right into the podcast. I just recently looked at a Financial Times report that indicated a couple of sectors in the American economy are in recession-like statuses, specifically blue-collar sectors. We're talking about manufacturing, construction, agriculture. And this is in direct contrast with the all-time highs we're seeing in the markets right now. It's just a tale of two cities, essentially. Like,
Yeah.
what is going on, Luke? How can we have this on one hand and then just booming stocks on the other?
Yeah, well, it's the bifurcation that we've talked about multiple times before in this podcast. The bifurcation between the real economy and the financial economy. That the real economy is struggling right now, has been struggling ever since early 2022, and has not really gained its footing since then. High inflation and high rates crippled the real economy in 2022. They continued to cripple the real economy in 2023 and 2024. And then tariffs added another punch on top of all that in early 2025. So the real economy has been struggling 22, 23, 24, 25 for about 4 years now. The financial economy woke up in late 22, early 23 with the launch of ChatGPT. So it's really AI. AI is creating growth in the financial economy, but that growth is narrow. It is not spreading into the real economy. So that's why you see this FT report, right? They did Moody's Analytics. I have the report pulled up too. Moody's Analytics coincident economic indicator for each industry, right? So they looked at each industry. How's each industry doing? What type of factors are they looking at right now? Manufacturing, recession-like conditions. Construction, recession-like conditions. Transportation, distribution, recession-like conditions. Federal government, recession-like conditions. Mining, agriculture, utilities, all pretty close to recession-like conditions. Information, education, retail, trade, leisure and hospitality, financial services, all barely expanding. The growth is in technology, healthcare services. That's where you're seeing the growth. This is AI growth. This week, I think it was on Monday, NVIDIA and OpenAI announced this massive partnership, $100 billion partnership, okay? NVIDIA is going to pour $100 billion into OpenAI to build 10 gigawatts of data centers. OpenAI is going to buy a bunch of chips. Huge deal. Biggest deal ever in the AI world. $100 billion, 10 gigawatts. That's going to create real economic growth for one very specific sector of the economy. Those companies and industries related to the construction of data centers and the development of AI applications will win big. One construction firm will win the contract to build those data centers. 99 will lose. For the 99 that lose, there's not much growth elsewhere happening because interest rates are still high, because inflation is still a problem. But for the one that wins, they're gonna. I mean, it's a heyday. It's $100 billion heyday, right?
Right.
Then when that happens, and you gotta find all the power equipment stuff. So like nuclear stuff goes up, Oklo, SMR, those stocks go up. The cooling equipment goes up. The networking gear goes up. So the whole ecosystem. When NVIDIA and OpenAI announce a $100 billion partnership, that's $100 billion that gets funneled into the economy. It translates into several hundred billion dollars worth of spend in the AI ecosystem. But that money does not leave the AI ecosystem. It does not go into residential real estate. It does not go into transportation. It does not go into manufacturing. It goes into one company for construction, but not construction of malls, right? So that's what's happening. You're getting a massive bifurcation between the real economy and the financial economy. And the question is, how long can this bifurcation persist? Because it's at some point, we're stretching the rubber band. At some point, there's too much tension, it just snaps back and everything kind of comes crashing down, more or less. I think we'd be remiss to say that this AI boom is going to go on forever and that the real economy is going to catch up. Now, I think the real economy is going to be the anchor that kills the financial economy. And I do think that we are due for some big AI stock market crash within the next 2 years. I don't know if it's 12 months out, 18 months out, 24 months out. I think the next 12 months we have a lot of runway. I think things look great for the next 12 months because bubbles pop on a hill of euphoria. Okay? So I think we're going to reach this peak of euphoria over the next 12 months and then we come crashing down. But again, I don't know if it's 12 months, 18 months, 24 months. All I know is that eventually we will have this day of reckoning because the real economy it's under a lot of pressure right now. Look at the consumer sentiment surveys. Look at the business sentiment surveys. They are depressed as could be. The real economy is struggling. Financial economy is booming. That cannot last forever. AI is single-handedly masking weakness pretty much everywhere else in the economy. And because the stock market is market cap weighted, all the AI companies are the big companies. They're dragging all the indices higher, But your average shop out there in America right now, it's not been a good year. 2024 wasn't a good year. 2023 wasn't a good year. 2022 wasn't a good year. So again, there's just a lot of strain and pressure. I think I also read a study that I think personal and corporate bankruptcies in 2025 year to date through July or through August, the most recent data, they're trending as high as they have since 2010.
Whoa.
So we're at a 15-year high in terms of corporate bankruptcies and personal bankruptcies year to date. So many yellow flags that are being waved right now. So many stressors underneath the surface. Those stressors do not mean the bubble pops tomorrow. Bubbles can persist for a long time. But they do mean that eventually the bubble pops. Eventually, the day of reckoning comes. So that's how you explain that FT article versus the stock market at all-time highs. That's how you explain the real economy struggling versus the financial economy booming. It all comes down to AI, which is another reason why I say AI with AI right now. Mm-hmm. You have to, the growth in Wall Street, on Wall Street, is all AI stocks. Oklo stock, we've talked about it a lot on this podcast. Nuclear stock, I call it the nuclear AI stock. They're going to be the power for data centers. That stock's like up 100% in like a month or two, right? Oracle stock, we talked about it multiple times. That stock's been soaring. I think it's up 115% in the last 20 weeks. So there is massive growth, but it is centered in one sector of the economy and therefore also centered in one sector of Wall Street, AI. So for now, it's got to be AI with AI, but do keep in mind that real economic weakness will catch up to this market. And eventually, I think the boom becomes a bust.
Yeah, 100%. I mean, I don't necessarily want to add more straws to that camel's back, but there was another Moody report that talked about consumer spending, specifically how 10% of the population accounts for more than half of that spending. Mm-hmm. And then if you look into the market in equities, 10% of the market owns more than 90% of the equities. Mm-hmm. So it just feels like this house of cards is building. And then even with AI specifically, I think MIT came out with a report that said more than 90% of companies using AI have not seen a quantifiable difference. So there's even this sort of concentration in the production and quality of use of AI in AI companies themselves or the companies that use AI. So it is concerning just to see the writing on the wall there.
Yes, I would say, the three things you brought up, consumer spending, low, basically mass household ownership of equities, and then low return on investment in AI. Let's tackle that one by one. So first you have consumer spending. Right now, and as has been the case for the last, I think, year and a half, wage growth has outpaced inflation. That's what I watch. For spending, I want to see real wage growth. When
Right.
real wage growth is positive, consumer spending remains healthy, the economy turns. 70% of US GDP is driven by consumer spending. So I watch wage growth versus inflation. When wage growth is greater than inflation and we have positive real wage growth, the consumer is fine. At least okay enough to spend.
Right.
Because the thing is, consumers, no offense to consumers, I'm like this too, consumers spend. We're always told to save for a rainy day.
Yeah.
We don't. If we have that extra money, maybe we save for a little bit, but then,
We like
that's
nice
a nice
things.
car, that's
Yeah,
a
we
nice
like nice
watch,
things.
that's a nice, and we spend. That's a nice dinner, that's a nice trip, and then we spend. So
Yeah.
if the consumer is making more than the cost of goods is going up, then they're going to spend that extra money. Okay. The problem is when inflation is greater than wage growth, when real wage growth is negative. Right now, real wage growth is about 3.9%. Inflation's awfully close to 3. The gap's closing.
2.9 right now, right?
Yeah. So if inflation keeps going up, which I think it can, then eventually that gap's going to narrow to 0. That's worry time. To me, that's more of a, right now I'm seeing a yellow flag of the convergence of the two, wage growth falling, inflation rising. The red flag turns into not a red flag, but a super big yellow flag when the two get basically equal or crossover. That could happen in the next 12 months. So that's something to watch. The other thing to watch, you mentioned low ownership, or low mass ownership of equities. Yeah, I mean, a lot of people have exposure to equities through their 401ks. But people aren't checking their 401ks every day. I mean, if you're working 9 to 5, like, you care about your salary, you care about your income, you care about the cost of goods at grocery stores, right? Again, talking about that real wage growth gap, right? That's what people care about. They don't care about the 401ks really. They'll check on it once a month. Yes, and then there's also the 5% or the 10% or the 1% that do have millions in the market and they do check every day. But that, again, that's not the 90%, that's not the 95%, that's not the 99%. The 99% care about their wages and the cost of goods, and how business is doing, if they're business owners or entrepreneurs,
Right.
is capital flowing, things like that. And the answer to a lot of those questions, they're not positive ones right now. So that's why you're seeing stresses in the real economy. And then, I'm sorry, what was the third thing we said?
MIT, I believe, did a study that indicated more than 90%.
Yes. That I think is what's going to stop the AI spending tidal wave. And that's a big deal because, again, like I said, the AI spending tidal wave is the one thing keeping things afloat right now. It is so big and so strong that it's doing the Iron Man and it's lifting everything up by its shoulders. As soon as that slows, we see the real weakness everywhere else. That's when you can get a big market crash.
Right.
What's going to cause that to slow? I think you just brought up what could cause it to slow. A low ROI on most AI projects. That I think there are, let's just hypothetically throw out, there are 100 AI projects out there. 2 of them are going to change the world, are changing the world. 98 of them will be doggone worthless. And that was the same thing in the late 90s. There were all of these internet sites popping up left and right. You know, pets.com, you had Webvan, you had all of these sites popping up. 98% of them were worthless. 2 of them were Amazon and Netflix, right? That's how this is also going to play out. We're going to realize come maybe 26, 27, once the spending slows a little bit and the tide goes out, you get to see who's swimming naked. A lot of these AI startups that are just coming to fruition right now aren't going to be worth much. They're not going to be delivering real ROI on their applications delivered to customers. I think ChatGPT will. I think Grok will. I think the big boys will. But all these other ones that are coming out, probably not. Or they're going to be producing much lower ROI than ChatGPT and Grok. And so they just eat that market share. The result will be, I think, a mass bankruptcy wave in the AI industry amongst those that are not in the top 1% of that industry. That's probably what causes that tidal wave to slow down. And when that tidal wave slows down, well, you got trouble everywhere else. Because nothing else looks that great. Literally nothing else looks that great. I know a lot of people in a lot of different lines of business. No one says business is booming. If you're in AI, right now you're saying business is booming. Or you're in financial services maybe because you're trading and doing stocks and all that and they're going up. Outside of those 2 lines of work, I'm not hearing anybody say business is booming. If that doesn't change in the next 12 months, and I don't think it will, as soon as the AI tidal wave of spending slows, yeah, it could be problematic on Wall Street.
Yeah, I think that's what the real fear is, because I mean, you could take some solace in, sure, some AI project's going to fail, but we've seen it before, like you said, with the dot-com bubble. But if the disparity between the real economy and this AI, I don't want to call it a bubble, but what it could be called is a bubble. If that isn't fixed, then what do we do? Do we go into cash after the end of that bubble? Like, how do we kind of safeguard?
Yeah, I mean, again, nobody has a crystal ball to say what the next 5 years is going to look like. I can take my best guess. My best guess is we boom like no other boom before, maybe only rivaled by 1999. We boom like crazy over the next 12 months, powered by, again, we're still getting these big deals, right?
For sure.
The biggest one ever was announced this week, OpenAI and NVIDIA, $100 billion. So I don't want people to come away from this podcast thinking, hey, Luke is bearish on stocks. I'm not at all bearish right now. I am full bull.
Yeah.
We are actively recommending stocks in our services. We're having great returns. We're on full bull. Okay, so we're full bull right now. I think the next 12 to 18 months is going to be a miraculous run in tech stocks. Then I think we're going to get a slowdown in spending, probably in late 26, early 27, propelled by a combination of just natural fatigue in spending. If you're spending $400 billion a year amongst the hyperscale 5, that can't keep going up forever. That is going to slow. I think the growth rates are going to slow. So you're going to see some waning off there, natural waning off there. I think you're going to get more inflation from tariffs in 2026. I do think that is going to happen. I think one of the reasons you haven't seen a lot of inflation yet from tariffs is because the big boys, Walmart, Home Depot, Amazon, they had a crap ton of inventory because they always keep a ton of inventory on deck, right? And so they had a crap ton of inventory, Target, all these companies, that they didn't need to buy new stuff just yet. They had old stuff that they were still selling to you that was not tariff impacted on price. According to Walmart's most recent conference call, that inventory is gone. So now they need to reload. Now when they reload in the fall, going into the holiday shopping season, they're going to reload with tariffs. They're going to reload at higher prices. That means it's going to come through to consumers at higher prices. So I think the CPI inflation impact we've seen from tariffs so far is maybe a third of the story. I think the 2/3, so we're up about 50 to 60 basis points on inflation since April. But if we call that a third, then that means the other 2/3 is going to be 100 basis points, maybe, right? So that gets us from 3% to 4%. That's problematic because remember, wage growth is 3.9. So if I'm right and that we do have another 100 basis points of reinflation in the pipe over the next 12 months, then that means by late 26 we're at 4% inflation and we're at 3.9% wage. Maybe that falls to 3.5. Now we're at negative wage growth. That's a problem. So I think that plus the natural fatigue in AI spending causes this boom to end in late 26, early 27. And then I think we have a massive reckoning period where it looks like the dot-com crash meets the great financial crisis. Because we have the valuation parallels and the euphoria and hype parallels of the dot-com era, the dot-com boom era. But at that time, the real economy was actually doing pretty okay. And there weren't many problems in the real economy. But today we have real economy problems, very similar to the great financial crisis type setup. So this is a mixture of real economic problems and financial economic problems. And if those two converge in 2027, 2028, you could get a big crash. And that crash could look like a combination of the GFC and dot-com crash. And so then I think that takes about 2 years to rinse through. And then I think maybe in 28, 29, you get this generational buying opportunity in AI stocks like you got in dot-com stocks in 03. This generational buying opportunity, buying Amazon at pennies. And then boom, and then we lock and load and the next 20 years is up and to the left for AI stocks. So that's kind of how I see this playing out. If we assume we have parallels to the dot-com boom and the great financial crisis right now, that's how I see that playing out. 12 to 18 months, boom, 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 like crazy. And then the next year or two, big washout, great buying opportunity, and then the next 10 to 20 years, steady secular growth in AI. That's how I see this all going down.
Awesome. Okay, so let's shift it to the current day. I want to talk about the Fed again. So they cut rates, we know. I think it's projected 2 rate cuts in 2026. Right. However, we just talked about the potential with tariff-induced inflation rising. And something else we talked about before is the accuracy of their unemployment projections. are probably going to be off with how quickly AI is rising. So what's next regarding the Fed?
Wouldn't everybody like to know?
Right. If only.
Yeah, so they cut rates. I think they're going to keep cutting rates. They didn't marry themselves to a long-term guidance on rate cuts.
Right.
I don't think that means they won't keep cutting rates. They said they're going to take things on a meeting-by-meeting basis. I do think the data, at least in the short term on a meeting-by-meeting basis, will support more rate cuts. Specifically, I think we're going to get continued labor market weakness. Look at that FT report we just talked about. Real economy is in trouble. AI is driving job losses in the financial economy even. So I think labor market weakness is a real thing that's going to keep spreading. So if it does, they're going to keep cutting rates. The question that really matters is not what is the Fed going to do. Everyone's hyper fixated on the Fed, and I don't know why. Because almost no interest rate that you get is based on the Fed.
Right.
It's based on the 10-year Treasury yield. Your mortgage rate, your auto financing rate, most business loan rates, any loan that you're getting that's past 5 years doesn't really matter. Or it isn't really based upon what the Fed does or doesn't do. It's based on the 10-year Treasury yield, which itself is somewhat impacted by what the Fed does or doesn't do. But it's what the Fed does or doesn't do plus what the market thinks is going to happen to inflation and the economy and other macroeconomic factors over the next 12 months, 24 months, 36 months. It's all about the market. It's all about the 10-year Treasury yield. So I don't really care what the Fed does. What I care is what does the 10-year Treasury yield do?
Right.
And the problem there, my saying here is you can't have your cake and eat it too. That there have been 4 major rate cutting cycles in the last 30 years, excluding COVID. COVID's a weird one because we shut down the global economy. So I think we can ignore that one because there's no parallels for that ever. No precedent, no parallels. Okay, throw that one out. We had a rate cutting cycle in right before the Great Financial Crisis. We had a rate cutting cycle during the dot-com bust. We had a rate cutting cycle in 1998, and we had a rate cutting cycle in 1995. Those are the last 4 major rate cutting cycles, excluding the COVID one. Okay. In 2 of those, stocks crashed because the economy was going into a recession.
Right.
2007, 2008, 2009, 2001, 2002. Those rate cutting cycles are what I call bad rate cutting cycles. The Fed was reacting to an economy that had already gone off the rails. They were unable to save it. Stocks crashed. The 10-year Treasury yield dropped during those rate cutting cycles. So the long end of the curve did drop. But in the good rate cutting cycles, 1995, 1998, where the Fed cut rates before the economy went off the rails, they were able to save it. The economy did get better. Stocks did rally during those rate cutting cycles. What happened to the 10-year Treasury yield? Didn't drop. 1995 was pretty much flat for 2 years. And then in 1998, it went up 140, 150 basis points over 2 years. So either stocks go up in a rate cutting cycle or yields go down in a rate cutting cycle. You do not get both. You do not get this dream utopia where the stock market rips higher and the long end of the curve drops. That doesn't happen because if stocks are ripping higher, it's because the economy is doing better. It's because inflation expectations are under check. And if that is true, then the Fed should not be cutting rates, right? So that's why then the long end of the curve goes up. So that's why you can't have your cake and eat it too. Either stocks are going to rip higher over the next 12 months or the long end of the curve is going to come down. You don't get both. And so people that are wishing for both right now, I think that that's not going to happen.
It's not feasible.
I think the long end of the curve is stuck. I think we're stuck at 4%. I don't think the long end of the curve is going to come down until the market crashes. When the market crashes, the long end of the curve will come down. But I think the market's going to rip higher for the next 12 to 18 months. I think the long end of the curve, the 10-year, I think its floor is 4%. Fed can cut all at once. Fed can cut to 0. That 10-year Treasury yield is not going below 4%. That's how I feel, at least. And so from that perspective, the gains in the stock market will remain narrow. Because we talked about it, why is the real economy struggling? High rates. High rates. If those rates stay high, again, not the Fed rate, the 10-year Treasury yield, that's what matters. If that stays high, there's no hope for the real economy. And therefore, there's no hope for a broadening out of the stock market rally. Russell 2000, small caps, they made a record high for the first time since 2021 last week.
Oh, nice.
Then they immediately reversed course. They touched the all-time high, hit their head, and then boop, fell right back down. So I just don't believe in the small cap rally. I don't believe in a broadening out. I don't think that there is broad strength in the economy. I think that there is narrow strength. Where the strength is narrow, it is super strong. So just stay focused on that. If you want to make money in this market, stay focused on AI, buy dips in AI, and keep riding with AI. Don't listen to these people say, oh, it's time to go take a nibble on some consumer staples or some materials plays or some industrials plays or some... No. Why? Why waste your time on that? Mm-hmm. All the growth is in one sector of the economy right now. Invest in that and forget everything else.
Gotcha. Okay. Now, speaking of investing, a stock we've talked about before, Opendoor. Mm-hmm. It's had a little bit of a pullback. Is it, time to buy the dip? Or are we looking to see, do we see that $50 mark or $40 mark from where we're at right now?
Yes, I would say Opendoor. The one thing I really don't like about this is the recent... So the stock really got got going because of Eric Jackson, that hedge fund manager who basically blew up in 2022, lost all his money, but then it had to come back with Carvana and is now trying to do another comeback with Opendoor. I have nothing against Eric Jackson. Yeah. I love his thoughts. I love his retail energy. I love how he's drumming up the crowd, getting the Opendoor army going. I think he's doing some really, really cool things. But the one thing I do not like is that he kind of muddied the waters by throwing another housing pick in the mix. So this week he went out at this Better Home and Financing or whatever, the ticker is BETR. He came out, this is my next 100Xer, it's actually gonna be a 350Xer, and that stock went from like $32 to $90 in like a matter of minutes, and it kind of came back down to around $60, but it's been red hot ever since he mentioned that. And you know what else has happened ever since he mentioned Better stock? Opendoor stock has done one thing. It's gone lower. It's nosedive. I don't like that. Because it's like, keep your focus on one thing. By shifting your focus to Better, or at least broadening out your focus to Better, BETR, a lot of the retail money that was just flowing into Opendoor on the Opendoor army is now clearly migrating away and thinking, okay, Better is the next hot thing. We're on Better, we're past Opendoor. I don't like that dynamic. It feels so memey and so but I think it's short term.
Right.
I think the one thing that, and this is major, the one huge thing Opendoor has going for it is it's more than the meme story now. Like if this was GameStop and it's like, okay, now GameStop's moving on to AMC, moving on to Bed Bath & Beyond, yeah, like you follow that trail of money. You say, okay, sell GameStop, move to AMC, sell AMC, move to Bed Bath & Beyond. Like you follow that trail of money. You do not hold. But I think with Opendoor, the reason you do hold is because there have been fundamental business changes beyond the meme stuff that suggests potential for long-term upside appreciation. There was one hedge fund guy or mutual fund guy, I think his name was George Noble, who was knocking the stock, former Peter Lynch, I think acolyte. I listened to some of he had a Twitter Spaces thing on it. I listened to some of it. I get why he's attacking it. The valuation metrics today make no sense, but it's a turnaround story. You don't value something based off of its current metrics when it's a turnaround story.
Right.
We've talked about, if this thing becomes an AI market maker over the next 5 years, gets 4% national market share, does half iBuying, half market making. The iBuying runs at 4 to 5% EBITDA. The market making get up to 30% EBITDA because it's a really high margin, annually recurring software system. Revenue business. Using all those assumptions, we came out to a price target of about $25 to $30. So I think that's fundamentally supported. Low shot of success, like I've always said, but that odd of success is going higher and higher with each of these fundamental business changes they're executing. So to answer your story about whether or not to buy the dip, you buy the dip if you believe in the company.
Of course.
Right? It's up to every individual. I believe in the company. Like, I like what the company is doing. I'm not, Eric Jackson and the Drake, they're trying to get the Drake the rapper in on it and all this stuff. Like that's all fun and nice, but I like it because I believe in the company. And so I understand, getting into it, recommending it. There's a low chance of success here. I understand that. This is not like a 4-year lunch money pick. This is not something to benchmark your whole portfolio around. Right. This is not an NVIDIA. This is not a Meta. This is not an Amazon. This is a potential future speculative play. Position size accordingly with that, or size your position accordingly with that information. So that's how I'm viewing it. Buy the dip or not buy the dip. You believe in the company and it's a small enough position, then yeah, sure, maybe buy the dip. I think there's fundamental value there. But don't get emotional about it. Be logical. There is a chance this fails.
Of course.
Be logical about that. Understand it's going to be really hard to turn this business around. Be logical about that. But also be logical about the fact that when the former founder, Keith Boy, goes on CNBC and says, we have 1,400 employees, I think we can get that down to 200. That means a lot of expenses can come out of the system. And that means what was a 4 to 5% EBITDA margin business at scale can maybe be a 10% EBITDA margin business at scale, if not higher. So also take that into consideration. When weighing all those factors, I think the bull thesis is stronger than the bear thesis today. And I think the stock can move up to $20 to $30 over time. I think calls for 82 are silly. I think calls for 500 are silly. Yeah, people out there calling for. I think that's silly. But I think a run between 25 and 50 is possible. So yeah, that's my take on Opendoor.
Gotcha. Yeah, even with I guess we call those conservative estimates. That's 400%, 500% as a bet. Yeah.
Exactly, and I don't know why people think they got to get this 1,000xer type thing. It's like that's not. Just be realistic with markets, and that's another bubblish behavior sign that's emerging, right? It's like in 2020 and 2021, people got really unrealistic about price targets and how fast stocks could go up, and that led to the crash of 2022, or at least played a part in it. I didn't see that behavior throughout 2023 and 2024. People were still very realistic and grounded. They are starting to become ungrounded now. When you see Better Stock, BETR, all it took was one guy to send a tweet, and that stock goes up 200% in minutes? That's not normal.
It's not normal.
That's bubblish.
Yeah.
That's bubblish. People are like, we're going to 82 and up to $50 is not enough. That's insane. This is insane, bubblish behavior that you tend to see when bubbles are forming in financial assets. Understand that as an investor, as an analyst. Understand that means this cannot go on forever. So yeah, that's another kind of sign in the mix where I'm just like, yeah, this can continue for now, but this is not a sign of a healthy long-term market.
Gotcha. Okay, I want to switch over to a more grounded sector of the market, specifically nuclear. Right. Stocks like Oklo have gone up over 100% in the past 2 weeks. Does it feel like the nuclear market is too hot, or is just this some of the rising in that particular market that we expected to come because of all the investments in AI data centers?
Right, yeah. So like I kind of said earlier, I think the market's going to boom over the next 12 to 18 months. I think it's going to be AI driven. I would buy dips in AI stocks. That applies to nuclear. Nuclear is a subset of AI for me. I think Oklo is a really fascinating story right now because of that NVIDIA OpenAI deal. Right, so NVIDIA is giving OpenAI essentially $100 billion to build 10 gigawatts worth of data centers, AI data centers. That's a lot of power. That's a shit ton of power. 1 gigawatt is about one massive nuclear reactor. So in order to power this $100 billion project, you need 10 massive nuclear reactors or hundreds of small nuclear reactors, of nano reactors. Who is leading the build out of this project? Sam Altman. It's not NVIDIA. NVIDIA is writing the check and giving it to Sam Altman. Sam Altman is leading the build out of this $100 billion AI data center project between OpenAI and NVIDIA. I'm calling it the Manhattan Project of AI because it feels like that. So Sam Altman is leading this charge. What is Sam Altman's former energy company? Oklo. Sam Altman used to be the chairman at Oklo. He stepped down from Oklo so that Oklo could win multiple AI data center contracts without conflicts of interest. That does not mean he has an unfavorable view of Oklo. Quite the opposite. He still loves Oklo, and I think he still owns a lot of Oklo.
Which would make sense.
So this guy is now going to get $100 billion to go and build a bunch of data centers. He needs power for those data centers. Who do you think he is going to choose to build the power for those data centers? Oklo. So I think Oklo is in a great position. That is one I would continue to buy on dips. And I think the whole nuclear complex applies to this as well. Because it's beyond this NVIDIA OpenAI $100 billion partnership, right? There was also reports of Meta and Oracle tying up for $20 billion. There's also reports of, I think, was it Amazon or Microsoft? Somebody is building a second big data center in Wisconsin for $4 billion. NVIDIA tapped CoreWeave for $6 billion of extra compute. So, I mean, it's more than just that $100 billion NVIDIA OpenAI partnership. It's billions of dollars being spent everywhere. That all that money needs to build data centers. Those data centers need power. The nuclear complex is a natural beneficiary of this. So I put nuclear in the basket of stocks I would buy on all dips over the next 12 months. That's where Oklo resides. That's where SMR resides. That's where Constellation CEG resides. Vistra, VST. Those are IPPs that have a lot of nuclear exposure, independent power producers. What else is in that complex? Centrus, LEU's the ticker. UEC, Cameco, CCJ, these are more the miners now. That whole nuclear complex, I think, is really ripe for a lot of gains.
Gotcha. Okay. And then onto another sector that is AI adjacent as well is quantum. It's been having some leaps and bounds, if you will. Mm-hmm. Same story, same thesis here. Is it too hot, or is it just the expectation that we were expecting because of the boom?
Yeah, I think quantum keeps leading. Yeah. I think quantum keeps leading. There's a lot of there are a lot of signs that quantum is entering its commercial era. Mm-hmm. IonQ won a big contract with who was it? Someone in the government to do outer space stuff. Oh God, I forget who it was. Anyways, they won a big government contract. Rigetti won a contract with the Air Force. You're seeing these contracts expand. IonQ also just had a big breakthrough in their, I believe, their photonics for long-term quantum networking, which is big for bringing quantum into the real world. It'll allow systems to communicate over long distances. Quantum computers to communicate over long distances. So there's a lot of evidence of quantum going commercial. And I think you're going to see that show up in the financial statements of all these quantum companies over the next 12 months. I think their earnings over the next several months are going to be very, very good. I think you're going to start seeing revenues really ramp up, and that's going to give more hope, more hopium, if you will, to the investors who are buying these stocks, and they're going to keep on buying, and those stocks are going to keep on running. Now, these are the stocks that will get hit the hardest when a inevitable crash does arrive. But again, that is at least 12 months away, if not 18, 24 months away. And so in that time frame, I think you could see quantum stocks double, triple, quadruple. They could go up a whole bunch more before their day of reckoning does arrive. So I would say stay locked and loaded with quantum is a good trade for now.
Gotcha. And even then, the day of reckoning will just be a huge buy the dip opportunity because quantum is the future, right?
Yeah, I mean, that's the thing. It's like, if you're truly, truly, truly a long-term investor and you got a 20-year, 25-year horizon, maybe you don't care about the day of reckoning that's coming. And I get that. I mean, I'll buy that argument. I just don't want to worry about it. I'm just going to buy this and I'll sell it in 25 years, put it on a coffee shelf. Okay, I get that. Like, I'm totally fine with that. But if you could,
right,
why wouldn't you? Let's say IonQ, it's at 70 right now. Let's say it goes from 70 to 200. And then it crashes from 200 to 20. And then it goes from 20 to 1,000. I mean, obviously what you want to do is buy it at 70, sell it at 200, avoid that 90% drawdown, buy it back at 20, a ton more of it at 20, and then ride that up to 1,000. So I get the whole thing of like, yeah, let's just ride it from 70 all the way to 1,000. I get that. Okay, if you got, all that time and all that patience and all that fortitude to stomach a massive drawdown. But personally, I'd rather 70 to 200, sell it at 200, wait for that big drawdown, buy it back at 20, load up super low, and then let that rip higher. So it's just personal preference. So for, this big drawdown I'm warning about, if you really are a long-term person and you're fine holding through that, then forget about it. Who cares?
Yeah.
But I just think, hey, if you have an opportunity to avoid a 80, 90% drawdown on a lot of these stocks, which I think it is possible, do that.
100%. Okay. And then I just want to switch back to what we call the real market. I want to talk about the housing market. I know with the most recent rate cut, we saw a huge bump in refi applications. But what else is there? What else should we be looking at in the housing market, Luke?
What is going on in housing? Like, it's a mess in housing right now. In my opinion, the problem with housing is it's a supply-driven problem. We don't have enough supply. I think that my research indicates, but after 2008, builders got so damn scared of the housing market that they underbuilt. Not just in 2009, and not just in 10, and not just 2011, but they underbuilt for years, from 2009 to essentially 2020. And then you had lumber shortages and labor shortages, and they underbuilt in 20 and 21 and 22 and 23 and even in 24 and still here in 25 now that you have tariffs and all that stuff going on. So home builders have underbuilt for 15 years. That's going to take 15 years to crawl our way out of that.
Right.
Like, you need to overbuild for 15 years now to get back to an equilibrium point that is healthy enough for markets. So the solution is long in the tooth. But the problem also is that there are massive ingrained incentives to not build more homes. Because most households' net worth, who are homeowners, is tied up in their home. Net worth is X, 0.8 times X is probably your equity in your home, right? Like that, people have spent so much money in the last 10 years buying homes, 15 years buying homes, that all their money is tied up into their home. Those people do not want to see their home prices go down. But if you overbuild for 15 years to get home prices, or to get affordability more in check, to get supply-demand more equal, well, if supply-demand get more equal, what happens to prices? Prices come down. That's the problem with the housing market. In order to fix it for the people that don't own a home, you break it for the people that do own a home. How do you work around that? How do you find a solution that is going to work for people that don't own a home to get prices down without breaking the wealth of the people that do own homes?
Right.
It's tricky. It's tough. And I'm not sure I have the answer. But I sure as hell know that what's going on right now is not the answer. Because what's going on right now is no one can buy a home. The market's completely frozen and we're not building. Like nothing good is happening. Nobody's winning here. And home prices are having to come down because no one's buying. And so everywhere I look on Zillow, like I told you, I replaced my social media scrolling with Zillow scrolling. I look on Zillow all the time. Nothing moves. Nothing's moving. And then it's like paper cut prices or paper cuts on the list, right? So you're at 790,000. You cut 6,000. You cut 5,000. And then just like these little paper cuts, right? And it keeps going on and on and on and on and on. And homes just sit, and then 790 turns into 740, and it still hasn't sold, right? And so it's like, nothing good is going on in the housing market. Rates are not going to go lower, in my opinion, especially on the mortgage rate, because the 10-year has only gone up since the Fed has cut rates. Mortgage rates have only gone up since the Fed has cut rates. Mm-hmm. I think that'll continue. Again, I think the floor of the 10-year is about 4%. So that means the floor for mortgage rates is probably like 6.3, 6.4, 6.5. We have a chance to push back up to 7. It just feels broken. Right. Feels very, very broken. I think that means that housing and housing-related stocks, I think there's a hope trade there. But I think, if by summer 26 the market still hasn't thawed, then that hope trade falls apart. So you got to be wary of that. Now, where there is growth is in the refi market. Okay, Rocket Mortgage, RKT, one of our favorite stocks. We've owned it for a little while now in our model portfolios. That stock is doing really well, and I think it's going to continue to do really well because refis, mortgage rates are lower right now than they have been over the last 2-ish years. There's going to be a lot of refi activity, and there will continue to be a lot of refi activity, and there will be more urgency if mortgage rates start to go a little bit higher. So everyone's like, oh, they're going to go higher now. I got to get in refi. So I think Rocket's going to really benefit from that refi activity, and other companies that are in the refi world. But as far as pure housing plays go, a little tough. Now, what could change here is the White House could come forward and declare a national housing emergency.
Right.
And if they were to declare a national housing emergency, there are a lot of levers they could pull to reinvigorate the housing market. They could exempt home builders from tariffs on lumber. That would be very, very helpful. They could provide incentives, maybe tax breaks for builders to build more. They could come up with additional financing routes, more friendly financing routes for people that are looking to apply for a mortgage. They can have down payment assistance. They can provide incentives for people to sell. You could do, I think it's called assumable mortgages, where you could move and assume the mortgage rate of the person that was there. So like if I'm buying from somebody that had a 3% mortgage back in 2015, I can assume that mortgage and assume that rate.
Yeah.
So there's a lot of things they can do. There are a lot of levers they can pull to get this market going. If they do that, the entire sector becomes a buy. All of housing becomes a buy. Treasury Secretary Scott Bessent has hinted that they might do that. So watch that very closely. Because as soon as they do, if they do that, as soon as they do that, that's the time to buy all housing stocks, Opendoor included. Everyone in the space will benefit from a national housing emergency declared by the White House, if that does happen. But again, if.
I got to ask, is there an almost artificial inflation of housing prices? Because it seems like the housing prices over the past 20 years have gone up way more than they should have. Wouldn't that cause a correction to happen in the pricing of homes themselves?
No, without more supply. Supply is so constrained. That's why you've had that massive housing burst. Like, again, we underbuilt for years and years and years after the great financial crisis. And that wasn't a problem pricing-wise because demand to buy a home wasn't that strong. The reason builders didn't build is because people didn't want to buy homes. People and builders alike were so scared after 2008, so scarred, that nobody wanted to buy a home. And nobody wanted to build a home. The demand wasn't there, so we didn't build the supply for that demand. And then COVID changed everything. All of a sudden, work from home, remote work, social distancing, all of a sudden everybody wanted to own a home. And so overnight, the demand switch was flipped from weak to super strong. Well, you can't flip the switch on supply.
Right.
You can't just flip a switch and say, oh, look, here's 1 million new homes. That's not how supply of homes works. You got to build them. That takes years. You got to get permits. There's a lot that goes in to building a new home. It takes a lot of time, a lot of money, a lot of resources. And so although the switch on demand was flipped in 2020, 2021, we did not switch the flip on supply. And we still haven't because, again, first off, in 2020, 2021, it was supply chains were shut down and there were shortages of lumber. So I couldn't build because I didn't have the labor or the lumber to build. Then in 2022 and 2023 and 2024, once the labor and lumber became available, rates were so high and inflation was so high and it was so expensive for me to build and so expensive to get a loan to build because it's a very loan dependent business, home building. Then now in 2025, it's, oh my God, the trade war is here and the tariffs are here and now lumber is going up. And so there's been a whole bunch of problems in the last 5 years where the supply switch just hasn't been flipped, even though the demand switch was flipped. So we're still in a structural undersupply of homes. So that's why prices are up. So again, supply demand economics. The way you get prices down or you stop price appreciation is you get that supply up. When's that going to happen? When are the builders going to start building? I'm not seeing it. Housing starts and permits, Not going anywhere. Flatlining at low levels. When are we going to rebound? If the White House declares a national housing emergency. That's when we rebound. Until then, or rates come meaningfully lower. Until one of those two things happens, or both of those things happen, we'll probably remain in a structurally undersupplied housing market. Not to mention existing home supply. Sellers don't want to move. Why would you trade in a 3% mortgage for a 7% one? Even a 6% one, even a 5% one. You got to get the current contract rate on a 30-year mortgage roughly equal to, give or minus a few basis points, the effective rate. The effective rate on outstanding mortgages right now, I think, is about 3.5%, 3.5%. The contract rate is about 6.5, so still almost double. That contract rate needs to come down to 4. If you get a 3.5 effective and a 4 current contract, then you start to get people wanting to move. But until you get there, the only people moving are those that really have to. If you don't have to move, why would you trade in 3.5 for 6.5? You wouldn't. Especially when consumer sentiment is in such a very bad position right now. So, I mean, I get it if consumer sentiment is really high. Yeah, I'll swap in 3.5 for 6.5 because I'm making money and the economy's good and I'm booming. But that's not how consumers feel. Despite the market being at all-time highs, that's not how consumers feel. And that's why we're structurally undersupplied.
Gotcha. Yeah, I would love some government intervention. If I could assume a rate from 2020, I'm all in.
I think excuse me. I think assumable mortgages is a pretty big idea. Opendoor could be at the heart of that. But I think assumable mortgages is a pretty big idea that could really help things out for sure. Because, yeah, like I said, that's when you close that gap, the effective and the contract rate on 30 years, right? If you make assumables, all of a sudden, you can assume mortgages of other people, and all of a sudden the contract and the effective, in practice, narrow dramatically. So that's when we close that gap and you kind of fix a lot of that undersupply problem. So I think it's a big component. But again, it hasn't happened yet, and until it does happen, yeah, the market will kind of remain pretty weak.
Pretty stagnant. Okay. That's all the topics we had for this week, Luke. No breakout stocks this week, but do you think there's anything we might have missed that you wanted to talk about?
No, not really. I'm at the tail end of a long day of talking. My voice is starting to go. That's why I'm chugging this vitamin water, folks. It's not an endorsement, the vitamin coconut water. See, I don't even know what I'm drinking, folks. I don't even. That's how long of a day it's been. I think we kind of talked about a lot of negative things. I do want to say that I am very bullish on the market over the next 12 months. I am short-term more bullish than you could be. I am also long-term very bullish on the markets. I just think in the medium term we got to have a reckoning period.
For sure.
Like that's it. This is 1999 and 1998. That means we still have 99 ahead of us. Best year ever for tech stocks, but it also means we have 2000 and 2002 ahead of us. Very tough time for tech stocks, but it also means we have 2002 to 2025 ahead of us, which is 23 years of secular growth in internet stocks. So you got to balance the good with the bad. I see a lot of analysts out there right now becoming cheerleaders. And when analysts become cheerleaders, as a listener, you got to get worried. It's I don't know. I don't want to name drop, but there are a lot of analysts out there who I really respect that have just become cheerleaders. Just pure cheerleaders. And I saw that in in 2020 and 2021, especially towards late 2021.
Yeah.
Really respected analysts that had conservatism, that really looked at things carefully, all of a sudden just became blind cheerleaders. And I'm seeing that. So I'm trying to counterbalance that. I am still super optimistic. I am still super bullish. I am a perma bull, really. But I'm not a cheerleader. I'm not going to go out here and say, we're going to go up forever. We're going to go up forever. No, I'm not a cheerleader. I'm an analyst. I get paid to analyze things. And when I'm analyzing the markets right now, it's telling me to be very bullish over the next 12 months, but very worried about the 2 to 3 year period after that. So that's what we're going to do. Lock and load, full bull, full steam ahead, next 12 months. Be very, very cognizant of the warning signs out there, and then listen to the tape. That's the biggest thing here. Listen to the tape. The market will tell you when it's time to get out. Right now, there's just a bid. There's a constant bid. So go with that bid. But as soon as we start to break some big technical levels, really watch the 200-day moving average. As soon as we start to trend towards that, the slope on that turns negative. That's when you're going to be like, all right, the day of reckoning has arrived. Let's close out. Let's wait for the crash. Let's preserve cash. And let's have cash ready to buy the dip when that turns into a buying opportunity. So those are my closing remarks for sure.
Awesome. I love it. Okay. There you have it, folks. Watch the tape. Be practical. And let's make some money. It's been another week of Being Exponential. We hope you've enjoyed. We have enjoyed ourselves. We'll see you next week.